Yeah, good morning. That's right. So we do see a negative outlook for banks globally in 2024. And as you said, it is basically about interest rates and monetary tightening. You could think of banks as being kind of like money factories, borrowing money, lending money, creating money. So they're inherently sensitive to the price of money in many ways. You said that 2023, we'd agree, has been in many respects a pretty good year for banks around all the world, except for the regional banks in the US that you mentioned, because the cost of money has gone up. That's lifted net interest margins through higher rates, but those same higher rates have not yet affected the cost of risk. So bad loans and provisions. 2024, we think will be more difficult. Central banks are winning the battle with inflation. Growth is slowing, especially in the US and China. So we think the ECB and the Fed will start to cut rates roughly in the middle of the year, and that's going to lead to some softening of interest margins.
Nick, looking at the operating environment that you anticipate to deteriorate, there are three factors here, but only one of them looks new. You've got weak exports, so we've had that really over the course of this year. Ongoing property market correction, well, we've been noting that on particular markets, the CRE side, but also on China. The third part here, muted private spending. So is 2024 the year where the consumer finally caves?
At the same time, growth, not necessarily a bad year as such, but just more difficult than in 2023.
So, Nick, I just want to weigh in on that when it comes to the private spending. I was saying, like, this year's been a year where the consumer has been resilient. Is next year, as we talk about this deteriorating environment, just a year where the consumer caves?
Yeah, the consumer, I think we see as probably staying relatively robust. We think unemployment is going to stay fairly low on the whole. So the problems that we see on the cost of risk side are more likely to come from the corporate side. So companies which have built up leverage over the last few years during the years of cheap money, starting to feel the pain. So that's really where we just expect the pressure to be more than on the household side.
Makes sense. That is the lag effect of monetary policy, isn't it, as those companies try and tap the market for refinancing. Loan quality, that's been surprising for the banks this year. I mean, we talk about tighter conditions with the aggressive rise that we've had in interest rates. Typically, you've seen loan quality falter. That's not been the case. And in fact, for most of the banks, by and large, there's been very little provisioning for that as well. What changes next year? Provisioning is ramping up, and are we actually going to see that deterioration in loan quality?
Yeah, it's really the lag effect that you mentioned. So it just takes time for these things to work through. So the positive effect of higher rates we've already felt this year. The negative effect is going to come through with this lag. So most likely next year. And that's probably going to show up particularly in places like commercial real estate, which we see as under pressure in some parts of the world. We talked a lot about that this year in the US. Also in parts of Europe and, of course, China. So these are some of the weak spots that are likely to create some of the provisioning.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.